I don't know. Sorry, excuse me. I don't know, but I would say that silver certainly is likely to have a huge, great squeeze at some stage.
Yeah, do you think that's what we've been seeing in terms of the gold and silver positions being reduced, the banks getting actually net long silver on the swap dealer report, pulling back in the gold market as well? And is that also connected to the Basel III regulations?
Well, I think you could say that, but if you look at the cycle of behavior over time, I mean, basically they pull it up, suck you in, push it down, shake you out, and it's just they do it time and time and time again, and it's difficult at this stage to know whether that's only what they're doing or whether this time around, I mean, particularly after the scare they had in 2000 when the Fed reduced the funds rate down to zero. You remember in March that year. At that point, the gold market just took off. I mean, it had already fallen, I think, from something like down to 1480 or something like that, and then it was straight up to 2000. So that that might have concentrated minds a little bit about getting too short. So yeah, they want to get an even book of that. That is absolutely clear. And that, I think, is independent of Basel III. I can't see that Basel III is a reason why they would do it. I mean, Basel III, as I said earlier, I think is something that the treasurers in the banks look at rather than the dealers. The dealers will deal with whatever resources they're provided by the Treasury. And I think that's the way round in which the Basel III thing is working.
Do you think it could be some impact from what we saw in the nickel market, which was right around the time that we saw this shift in gold and silver, and certainly plausible that, they could have been concerned after watching that?
It wouldn't surprise me at all if we have another nickel event. And I would have thought that the commodity which is at greatest risk of that is probably silver.
Yep.
I mean, what we see is silver is probably the most important metal for this new electronic age, with solar panels, with the electrification of transport. I mean, the whole thing. Silver is desperately important. When you look at the price of lithium, how that's shot up, the price of uranium, how that's shot up. I'm talking about non-fossil, commodities involved with the non-fossil environment. Silver has been very much left behind. And I was reading something sent out by researchers from, I think it was Metal Focus, that the demand for silver in India has just taken off. I mean, it's been huge in the first half of this year. And for that reason, we've seen stocks in the London vaults have been declining. So, yeah, I mean, there's no physical around. I think generally that is true to say. So you've got a situation where, I mean, if I was a bullion bank, I would want to get an even position or even a slightly long position under those circumstances. And I'm sure that, at some stage, particularly if this thing, if we get a systemic crisis, which in the banking system, I think is beginning to be recognized as a real likelihood again, then, what do you want to do? I mean, if you can't get your gold shorts back, then, you might be able to defray the loss a little bit by having a long silver position. And I'm so, to my mind, I think that it is quite likely that silver could have that sort of spike. Now, having said that, the LME has, I think, stopped dealing in silver. I haven't looked recently, but I read somewhere that they've stopped dealing in the precious metals. LME Precious has been closed down. So I don't know. Sorry, excuse me. I don't know, but I would say that silver certainly is likely to have a huge, great squeeze at some stage. And that's the metal I would put my money on for a repeat of the nickel situation.
Well, that would certainly be welcome news. And you mentioned that some of the conditions that are happening now, we're recording on Tuesday, and here was the IMF cuts global GDP, raises inflation outlook, warns world teetering on the edge of recession. You've also written about some of the things that are happening in Europe. And of course, we have the Fed raising interest rates in the US, which has created problems around the globe. And what could you share there to put that into perspective for people?
Yeah, there are two things I think we need to take on board. The first is the obvious one, and that is that the interest rate environment has changed completely. From about 1980, interest rates have been in a long-term decline trend. And that ended with the Fed at zero. It ended with the ECB at -0.5. It ended with Japan at minus whatever it got down to. Japan is still there, asleep at the switch. The ECB is just waking up a little bit. The Fed is already moving rates up, and we're going to get another meeting, I think this week, aren't we? This is being recorded, what, on the 26th? So, yeah. And the Bank of England has woken up a little bit as well. The fact of the matter is that interest rates, official interest rates in the region of 2%, are way behind the curve. I mean, we've got inflation rates measured by the CPI in the region of, well, closer to 10%, basically. And we've got the RPI here, which was discarded some time ago because it was costing the government too much in indexation. So they swapped it for the consumer price index, but that's now running at 11.8%. You know, that's an official inflation thing. So to have you know, a bank rate at around about 2%. I mean, it's a broken market in effect. What they're doing is they're saying that, well, you know, if we can just ride this out, it'll come back to 2%. The reason we got such high inflation is that, first of all, we had the problems with supply chains, and now, of course, we've got this Ukraine situation. But Putin's bound to lose that one, and then everything will return to normal. Well, dream on. I mean, no, you know, this is wrong. I mean, I was looking at our official statistics and forecasts here, and they're still talking about it going back to 2%. You know, CPI back to 2%. So that's you know, if you like, the first thing. The second thing, which I think is also part and parcel of this problem, is something that Jamie Dimon said at a banking conference at the beginning of this month. He stood up and he said, a couple of weeks ago, I said that the economy was facing storms. I'm upgrading that to a hurricane. We face a hurricane. That's what he said. Now, his chief economist rode back on that and said, oh, no. I don't think he quite said his boss misspoke. I mean, you know, you don't say that about Jamie Dimon, but I can tell you what, Jamie Dimon was saying something terribly important, and that is that at the margin, JP Morgan is going to reduce its outstanding bank credit, because his message was basically there is too much risk for a bank which is highly leveraged. We do not want to get caught out. We do not want to get caught out with counterparty risk. So coming back to what you're saying about gold, you know, look, you know, I think Jamie Morgan is in, if you like, a mode to sort of start shutting down a lot of JP Morgan's operations. I mean, obviously, as the Fed's main channel into the US banking system, you know, there's not a lot he can do in certain respects. But I'll tell you something else, and that is that any other banker, because they all work as a cohort, they all think the same way, they all have the same problems. Any other banker who has not already worked out that he should reduce the outstanding bank credit that he has in the market on his balance sheet will certainly have noted what Jamie Dimon said as the leading commercial banker in the world, and will now be very seriously thinking of doing so. So we've got, on the one hand, rising interest rates, and on the other hand, we have the potential for a massive contraction in bank credit. Now, what does that do? It means that banks basically call in loans. We've already seen them, if you like, reducing the outstanding loans backing speculation in financial securities. I mean, if you look at the NASDAQ figures for margin debt, I mean, that's come down quite sharply. It's still very, very high, and it's got a long way to fall. you'll see them basically freeing up their balance sheets where they can. And a lot of that will be turning around to companies who have overdrafts and saying, we're not going to either not going to renew your overdraft facility, or we're going to reduce it. Now, so what does that do? It means that companies which don't make enough money to cover their expenses are going to have to start cutting quite hard. So what we're looking at is a situation where rising interest rates, through the effect of contracting bank credit, is going to contract GDP, because GDP is no more than the sum total of credit in the economy. That's it. That's what it is. It's no more than that. Don't think that GDP actually tells you what's going on in the economy other than the expansion or contraction of credit. So, and this is something that all politicians, all Keynesian economists get absolutely wrong, simply because they don't understand banking, they don't understand money, and they don't understand credit. GDP, quite simply, is credit. Now, if the banks are going to start contracting credit, then GDP is going to fall off a cliff. That is the message that we were getting from Jamie Dimon. And that is why, I guess in the background, the Fed turned around and said, oi, you can't say that, for Christ's sake. So, and that's why the chief economist was instructed to sort of row back a little bit, if you like, and no, you know, all that sort of stuff. But I tell you that the thing that really matters is what's going to happen to bank credit. Banks are highly leveraged, and they're particularly highly leveraged in the Eurozone and also in Japan, where their leverage is over 20 times on average. And if you look at the Eurozone, the worst is Group Crédit Agricole at 27 times assets to balance sheet equity. And you look at the share prices of these banks, they are all standing at massive discounts to book value. What does that tell you? It tells you that the market's saying that these are not good investments, they are unsafe. Normally what you would do is you would try and buy things which are cheap because they are close to book value. This is deep discount to book value. This is not good news. We have a banking crisis on the way, because if you have a contraction of bank credit, it's the cycle of bank credit, which happens every 10 years. This has been going for 13, so it's a bit too long. I mean, when this one happens, when this one blows, it's going to be far bigger than what happened back in 2008, 2009 with the Lehman failure. This is a very serious situation which we face. So those are the two things to look at: rising interest rates. And of course, the other thing is, if you look at the Eurozone banks rely on their liquidity, for their liquidity on the repo market. And what they do is they push in collateral, most of which is bad debts, but has been passed by the local regulator. Oh, it's all right as long as you get it off my patch. So that goes into the Target 2 system. They get cash back. The amount of the size of the repo market is 8.7 trillion euros last recorded. Now compare that with the other way round in the US. The reverse repos are $2 trillion. Right. So that gives you an indication of the seriousness of the situation in the Eurozone. You raise interest rates, then that liquidity for the banks dries up. I mean, they should have liquidity. The way a bank works is it creates liquidity by making loans, because on the one hand, you create a loan, that's an asset on your balance sheet, but you've got to have something on the other side of the balance sheet to counteract it. And that quite simply is a customer deposit. So, one balances the other. So it's easy to create liquidity. But your problem is that in a stagnant economy, and an economy where the regulator says, well, lending to commercial entities is risky, which is what the regulators have said, lend it to governments instead, you can see that the whole situation is actually very, very precarious. I mean, I'm just touching the surface of the problems within the global banking system. But believe you me, watch out for the contraction in bank credit. It will be recorded as a recession. It will be recorded as a slump, because everybody makes the mistake of automatically thinking that the contraction of credit is, or rather the expansion of credit, which is the way they run, it usually happens, is growth, economic growth. It's not at all. It's just the expansion of credit. The contraction of credit is very, very severe because of the signal it sends to you that actually it's not so much people not spending, companies not producing. No, it's banks not making credit available. That's the key thing.